Greetings, everybody. Welcome to our chapter 4. This is financial accounting, Spiceland. I'm posting these on YouTube. This is for my class, but I'm posting them on YouTube. If you like them, subscribe, and happy to be here. So guys, we're going to talk today about cash. And then because we're dealing with cash, it's so important to understand internal controls for a company. So there's a lot we're going to cover today. We're going to start talking about internal controls. Now, why do companies need internal controls? For a lot of reasons. Accidental errors and intentional errors. So accidental errors are just normal things that can happen when you're human. Accidental errors in recording transactions or in possibly applying accounting principles. Because, you know, we make mistakes, we're all human. And then there are sometimes people that don't know possibly the right way in which to handle a transaction. So we need internal controls to check up on accidental errors, but we also need internal controls for those who intentionally try to deceive another person for personal gain. That is called fraud. Fraud is alive and well in the business community. For fraud to occur, there must be 3 elements that are available. This is called the fraud triangle. There must be an opportunity that allows the fraud to happen. There must be motivation for whatever reason someone feels the need to commit fraud. It can be some type of need. And then the individual must also rationalize their behavior. Now, rationalizing it means they justify it in some manner. They might even justify it by saying, but I'm going to pay it back. Or they might say, well, I'm not getting paid enough. I deserve this. However they rationalize it, they've got to have these 3 elements. There's an opportunity to commit fraud, there's motivation, and there's rationalization. Now, a company can't handle or can't deal with or do anything about their motivation and rationalization. But what a company can avoid is the opportunity. So internal controls attempt to eliminate the opportunity for fraud to occur. Internal controls are used to protect, or what we call safeguard, a company's assets, and then also improve the accuracy and reliability of accounting information. Basically, 20-some years ago, there were all kinds of companies committing major fraud. And so all of these accounting problems or scandals or just corruption encouraged Congress to make some decisions. And so Congress created what was called the Sarbanes-Oxley Act of 2002. The Sarbanes-Oxley Act was passed by Congress and applied only to companies that were public companies, companies that were required to file their financial statements with the Securities and Exchange Commission. So public companies, meaning those that were allowed, their stock was allowed to be traded in the public arena. This Sarbanes-Oxley Act basically created guidelines for internal controls and guidelines regarding the auditor and the client relationships, what they could and couldn't do. So internal controls was a new piece where each year the company needed to report on the internal controls of the company. So remember though, these accounting scandals were what prompted the Sarbanes-Oxley Act to be passed. And there were various guidelines in it, but basically the SOX Act, Sarbanes-Oxley, set forth guidelines related to auditor-client relationships and additional internal controls that required the company's management, along with auditors, to document and assess how effective the company's internal controls were. So we'll start with our first question of the day. Which of the following statements is not true of the Sarbanes-Oxley Act? A, all companies in the US fall under its provisions. B, it helped establish guidelines for internal control procedures. C, it helped establish corporate executive accountability. Or D, it helped establish guidelines for auditor-client relationships. What do you guys think? There's 10 of us or 9 of you. I want 9 answers in the chat box. Which one is not true? We're missing some. So right now, guys, we're on this question. Post your answer. It is correct, guys. Most of you got it right on. All companies are not required to fall under this guideline. It's only public companies. Only those companies that have to report to the Securities Exchange Commission. Now, there are components of internal controls. You see, based on this screen here, that we start with the control environment. From there, we move up to what's called risk assessment. Then we've got control activities, and then we have monitoring. So basically, the control environment is just the overall tone that is at the ethical environment of the company. It includes policies related to management's philosophy, assignment of responsibilities, and organizational structure. Next, we have our risk assessment. It looks at the internal and external risk factors that could prevent a company's objectives from being achieved. Does this company deal with a lot of cash? What are the risks associated with this specific company? From that risk assessment, we then develop control activities, the policies and procedures in place that are set up by the company, who authorizes spending, who reconciles various accounts, and how do they separate duties. From those control activities, then, you monitor, continually monitor the internal activities to make sure they are functioning as needed. So this is the system in place in each company that really determines how they set up their internal controls. Separation of duties. So we're just going to take a movie theater and look at various controls they may have in place. So for this movie theater, they may have separation of duties, meaning the employee who's selling the movie tickets wouldn't also account for all the cash at the theater. Another example of controls, the concession supply should be kept in a locked room with access only allowed to authorized personnel. Then there should be certain authorization. Only theater management should be authorized to make purchases over a certain amount. And then employees should be made fully aware of the company's internal control procedures, their ethical responsibilities, and what they should do to report activities they're suspicious of. Then for e-commerce, theaters should maintain and systematically check firewall settings that prevents any unauthorized access to accounts or to credit card numbers. Now, the detective controls, reconciliations, are where management periodically needs to determine if the physical assets of the company really match what they're saying is on paper, what agrees with the accounting records. And then performance reviews are the amount of concessions sold should be compared to the number of tickets sold over a period of time. And then ultimately having audits where independent individuals come in to assess the theater's internal control procedures and to see if there's anything that seems irregular. Know that the CEO and the CFO each year must sign a report certifying the adequacy of internal controls. The auditors must also provide an opinion on management's assessment of internal controls over the financial reporting, and they also have to provide their own opinion on the company's internal controls over financial reporting. So guys, if a company places cash receipts from the day in a safe or bank deposit box, what type of control would this be? Would it be A, separation of duties, B, physical control, C, reconciliation, or D, performance review? Why don't you put it in the chat box? Physical control by placing it in the safe or the bank deposit box. That cash is being secured. Important items like cash should be kept in safe places. Now, guys, we're going to look at this problem, and we are going to see these various statements about internal control and see if they're true or false. Okay? So the first one says the components of internal controls are built on the foundation of the ethical tone set by top management. Is that true or false? Yes, it's true. Once every 3 months, managers need to review operations to ensure that internal control procedures work effectively. Is that true or false? Guys, it's false. Do you know why? They should be happening more than every 3 months. They should be happening all the time. Next, collusion, which we didn't talk about, but collusion refers to the act of a single individual circumventing internal control procedures. Actually, it's 2 or more people circumventing internal control procedures. Number 4, detective control procedures are designed to detect errors or fraud that have already occurred, while preventative control procedures are designed to keep errors or fraud from occurring in the first place. You guys think that's true or false? It's true. Fraud committed by top-level employees is more difficult to detect because those employees more often have the ability to override internal control features. Guys, that's true. A good example of separation of duties would be having one person collect cash from customers and account for it, while having another person order inventory and maintain control over it. No. In this case, the person that's collecting cash shouldn't be accounting for it. And the person that's ordering inventory should not maintain control over it. Employee tips historically have been the most common means of detecting employee fraud. Guys, that's true. Detective controls include reconciling the physical assets of the company with the accounting records and comparing actual performance of individuals or processes against their expected performance. Yes. Okay, let's all do 9. Effective internal controls and ethical employees ensure a company's success. What do you guys think? I want you to write in the chat true or false, yes or no. Okay, guys, guess what? This one's going to blow your mind. It's false. Because think of this. Internal controls and ethical employees are a great step. But a company's success isn't just built on that. It's built on, do they have the right product? Do they have the right gig? You know, success is involved in so many pieces. This helps, but it doesn't ensure a company's success. Now, limitations on internal controls. An effective internal control system can't turn a bad employee into a good one. Internal control systems are susceptible to collusion, where 2 or more people act together to circumvent internal controls. Top-level employees who can override internal control procedures have opportunity to commit fraud. And effective internal controls and ethical employees alone don't ensure success or even survival of a company. Guys, everyone in the company has an impact on the operations and effectiveness of internal controls. But who must ultimately take the final responsibility? Is it internal auditors? Top executives? The firm's attorneys? Or the majority stock shareholders? Ultimately, it's the executives who run the company. The shareholders own the company, but they hire the management. Ultimately, it's that management who's responsible for the success of internal controls. So guys, we're going to look at this exercise. And for each scenario, we're going to look at which control activity could be violated, such as separation of duties, physical controls, proper authorization, employee management reconciliations, and performance reviews. And if there's no activity violated, we'll say none. So a manufacturing company compares total sales in the current year to those in the previous year, but does not compare the cost of production. Performance reviews would be violated in this scenario. So that employees have easy access to office supplies, a company keeps supplies in unlocked cabinets in multiple locations. Guys, they don't have physical controls on their assets. Not cool, not a good thing. At the end of each day, a single employee collects all cash received from customers, records the totals, and makes the deposits at the bank. Separation of duties. They need one person to collect the cash. Then they need another person to record the totals and another to make those deposits. They need to separate those duties involving cash. At the end of the year only, the company compares its cash records to the bank records of cash deposited and withdrawn during the year. They need reconciliations of quite a bit more than just once a year. A company encourages employees to call on an anonymous hotline if they believe other employees are circumventing internal control features. Nothing's being violated here. It's a good thing. It's a good thing that they have anonymous reporting. Remember, that's how many employee tips happen. All employees have the authority to refund a customer's money. They should have someone that authorizes that refund of money. So cash, what is cash? Well, cash can be cash, coins and currency, checks, savings accounts, checking accounts, credit card sales, debit card sales, and cash equivalents. All of this total our cash balance. Which of the following, though, would not be considered a cash equivalent? Would it be credit card sales for the day? Debit card sales for the day? Money orders? Or certificate of deposit, CDs that mature 1 year from now? What do you think? Certificate of deposits that mature 1 year from now. The reason that is not cash is a current asset. But a CD that matures 1 year from now is held longer. Since the CD doesn't mature until 1 year, it would not be considered a cash equivalent. Okay. Now, we're going to talk about controls over cash receipts and cash disbursements. In a company where internal controls are operating effectively, each day for cash, an employee should open the mail and list the checks. Each day, a different employee should deposit cash and checks into the company's bank account. As soon as possible, a separate employee should record cash receipts in the accounting records. And one should accept credit cards or debit cards to limit the amount of cash being handled. In regards to cash disbursements, disbursements should be made by check, debit card, or credit card. All expenditures should be authorized. Authorizing employees should not also sign the checks or prepare the checks. Checks should be serially numbered and should require 2 signatures for larger amounts. Periodically, the debit and credit card statements should agree with the purchase receipts. There should be maximum purchase limits. And the cash disbursement duties should be separated from the cash receipt duties. Now, in this chapter, we're going to look at how we reconcile a bank statement. I know many of you guys who have checking accounts haven't ever done this before, so you're going to learn how to do this. Know that the balance of cash in the company's records probably won't equal the balance of cash in the bank records. And it's because of timing. A bank reconciliation matches the balance of cash in the bank account with the balance of cash in the company's own records. It's timing differences of what makes them not balanced. Timing differences occur when the company's records transactions either before or after the bank records those same transactions. So we're going to look at a bank statement, and you see in here the ending balance as of March 31st for the bank is $4,100. You see $4,100. Now, per the company's records, the ending balance as of March 31st is $2,880. Our bank reconciliation is going to match them. Reconcile the bank's cash balance. Cash transactions that have been recorded by the company that haven't hit the bank yet is what we need to reconcile. So deposits outstanding and checks outstanding. Deposits outstanding are those cash deposits of the company that haven't been added to the bank's record of the company's balance. And then checks outstanding, checks that have been written from the company but have not yet cleared the bank. They have not yet been subtracted from the bank's records. So here we see the cash receipts of the company, and we see the cash receipts known by the bank. Okay, so we see the $3,600 on both the company and the bank, and we see the $1,980 deposit that was in the company and that was in the bank. However, the company shows a $2,200 deposit that's outstanding. It's not in the bank balance yet. So that's a discrepancy that the company shows, the bank does not show. Also, with checks, we see check 293 has cleared the bank. We see check 296 has cleared the bank, but there looks like a discrepancy on check 294. We recorded it as 2,600. The bank recorded it as 2,900. We got to figure out who screwed up, probably the company. And then you see check 295 and 297 have not yet cleared the bank. Those are still outstanding. So to reconcile the bank portion, we will take the bank's balance. We will add the deposits outstanding, subtract the checks outstanding to come up with the bank balance per reconciliation. Now, when we reconcile the company's cash balance, these are going to be cash transactions that we recorded by the bank, but the company doesn't know about, such as common items, collections made by the bank on the company's behalf, or interest earned on the average daily balance. Then items that may decrease the company's cash balance that the bank knows about that the company doesn't yet may be Nsf checks, non-sufficient funds, debit card purchases, electronic fund transfers, and bank service fees. So you see here in the bank balance, in the bank statement, you see a deposit of $3,000 on March 9th. And that had $200 of interest. You also see interest from the bank of $20. Then as far as withdrawals go, you see an EFT, electronic funds transfer of $400, an NSF of $750, a debit card charge of $200, and service fees on March 31st of $50. So these are items the banks recorded, the company has yet to record. So we need to show
Hello.
on the side. What?
I can't see the screen anymore.
Can anyone else not see it? Guys, is anyone else having problems seeing it? Sorry about that, guys. Can you see it now?
No, I can still see it.
How about anybody else? Can anyone else see it? They can see it. So can I tell you what I want you to do? I want you to go out, leave
Okay.
the meeting and come back in, and I'll admit you, okay?
Okay, thank you.
You bet. Guys, excuse me 1 minute. So guys, on this bank reconciliation, for the company side, we're going to take those items that the bank recorded that the company has yet to record and show those. And so in this scenario, can you see now?
Yes, Thank you.
Great. You're welcome, hon. So guys, we're taking those items that the bank has recorded, but the company has not recorded. The note received by the bank was for $3,000. It told us 2,800 was the note and 200 of it was interest. The interest earned on the bank account was $20. We had an Nsf check, meaning the company received a money from a customer. When they went to deposit it, there were not sufficient funds, so it got returned. The Nsf check of $750, a debit card for office equipment of $200, electronic funds transfer for advertising $400, service fee of $50, and we needed to correct the rent expense error, so it looks as though the bank was right, but we recorded that check to be off $300. Do you see, once we do this, the bank balance per reconciliation is $4,200? Do you see the company balance per reconciliation is also $4,200? It matches. That's what a bank reconciliation is meant to do. It's reconciled. Guys, record this slide. I'm going to give you 2 minutes while I go get a drink here. And I want you to write down this slide because this will help you understand exactly how to prepare a bank reconciliation. So once you clearly understand this slide, write it down, keep it on the side of you. So when we go to do some bank reconciliations, you clearly understand what's reconciled on each side of the reconciliation. Remember, all of this is just about timing differences. The bank knows things before the company knows things, or the company's recorded things prior to the bank understanding them. So, which of the following items would be found on the bank side of the bank reconciliation? Interest income received on the account, a deposit outstanding, an Nsf check from a customer, or service fee charged by the bank. Which of these does the company have recorded? The bank has yet to record. Awesome, guys. You're right on. The deposit outstanding is the answer. The company shows that deposit, but it has yet to hit the bank. Common items that are shown on the bank reconciliation include deposits outstanding, checks outstanding, and bank errors. How would an Nsf check from a customer be treated on a bank reconciliation? Would it be an addition on the bank side, a deduction on the bank side, an addition on the company side, or a deduction on the company side? Awesome, guys. It would be a deduction on the company side. Remember, guys, sometimes people think an Nsf check is a bad check written by the company instead of a bad check written to the company. When an NSF check occurs, the company has deposited a customer's check, but the customer did not have enough funds to cover the check. The company must adjust the balance of the cash account downward to reverse the increase in cash it recorded at the time of deposit. Updating the company's cash account, you look at items used to reconcile the company's cash balance. You debit cash for items that add to the balance, and you credit cash for items that subtract to the balance. So when we adjust items on the company side, we're going to need to create a journal entry for those. So items that increase the company's cash balance, we debit our cash. We'll credit notes receivable because there must have been a note outstanding we finally received. So we credit it. We credit our interest receivable, and we credit our interest revenue. The items that decrease our cash, we will credit that to cash. And we'll debit everything else. Our accounts receivable, the NSF check from a customer, we thought cleared their account, zeroed it out. But since it wasn't good, they now still owe us that money. So we debit our receivable. For items we purchased, we debit equipment. We debit our advertising expense, our service fee expense. And since our rent expense, the check was short $300, we will debit that rent expense to increase that. Remember, we only record transactions to the company that affect only the company side of the bank reconciliation. How would an NSF check from a customer be recorded in the accounting records, guys? Would it be a debit to accounts receivable and a credit to cash? Would it be a debit to cash and a accounts receivable credit? Would it be a debit to accounts payable and a credit to cash? Or would it be a debit to cash and a credit to miscellaneous expense? What do you think? It would be a debit to accounts receivable and a credit to cash. Some students try to update the cash account for deposits outstanding, checks outstanding, or a bank error. Company does not need to adjust for these items related to reconciling a bank's balance because they're already properly recorded in the company's accounting records. Let's look at this problem here. Spielberg Company's general ledger shows a checking account balance of $22,970 on July 31st, 2018. The July cash receipts of $1,885 included in the general ledger balance are placed in the night depository at the bank on July 31st and processed by the bank on August 1st. The bank statement dated July 31st shows bank service fees of $55. The bank processes all checks written by the company by July 31st and lists them in the bank statement, except for one check totaling $1,460. The bank statement shows the balance of $22,490 on July 31st. prepare a bank reconciliation to calculate the correct ending balance of cash on July 31st, 2018. Record the necessary entries to adjust the balance for cash. So if you look at this, we show the bank balance of $22,490. We show the company's balance of $22,970. It's telling us the July cash receipts of $1,885 didn't hit the bank until August 1st. So this is going to be something that we'll have to adjust or reconcile on the side of the bank. It's telling us the bank showed service fees of $55 that weren't part of the books. It's telling us the checks that showed up with the company but didn't show up with the bank is a check for $1,460. I want you guys to attempt to try this for a couple minutes to see if you can get the reconciliation to balance. I'm going to give you a couple minutes here, guys. So as you see here, the first thing we do is show the company's balance of $22,970, show the bank balance of $22,490. The items we're going to add to the bank include things that the company's already recorded that the bank hasn't recorded yet, such as deposits outstanding and checks outstanding. That's it. The items we record on the company side include things the bank has recorded that the company hasn't yet recorded. And there's only one thing, the bank service fees. Do you see that when we add the deposit outstanding and subtract the checks outstanding, the bank's balance is $22,915? And over on the company side, when we subtract the service fees outstanding, are not recorded by the company, we get $22,915. We balance, guys. You will always balance. Then we have to record journal entries only on the company side, not the bank side. We don't care about the bank. The company's records, anything we add to the company, we need to record. So we show the service fee expense of $55 and we credit our cash. Okay. Here's another one. On October 31st, Damon's general ledger shows a checking account balance of $8,397. The company's cash receipts for the month total $74,320, of which $71,295 have been deposited in the bank. And guys, what does that mean? The difference has not been deposited into the bank yet. In addition, the company has written checks for $72,467, of which $70,982 has been processed by the bank. The bank statement shows an ending balance of $11,727 and includes the following items not yet recorded by the company: bank service fees of $150, a note receivable collected by the bank of $5,000, an interest earned on the account balance plus from the note of $320. After closer inspection, Damon realizes that the bank incorrectly charged the company's account $300 for an automatic withdrawal that should have been charged to another customer's account. The bank agrees with the error. Prepare a bank reconciliation to calculate the correct ending balance of cash. Okay, so what we're going to do here is we start with the balance for the bank, which said $11,727, and the balance of the company is $83.97. Okay, we'll start with the bank side. Deposits outstanding will be the difference between the $74,320 and the $71,295, which is $3,025. The checks outstanding will be the difference between the $72,467 and the $70,982, or $1,485. And since the bank erred and took $300 incorrectly out of the account, we will adjust that and add back that $300. So our bank balance per reconciliation is $13,567. Now for the company side, we're going to add the note received by the bank of $5,000. We'll add the interest earned of $320. And we'll subtract the service fee of $150. And guys, do you see our bank balance per reconciliation is the same as our company balance per reconciliation? $13,567 for both sides. Now what we need to do is anything we adjusted on the company side, we're going to need to record journal entries. The note received, the interest received, and the service fees. So we're going to show cash is debited. We credit our note receivable, $5,000, and our interest receivable of $320. Excuse me, that's called interest revenue. Then the service fee that was subtracted of $150, we debit our expense, service fee expense, and we credit our cash of $150. Anybody have any questions on this? Now, sometimes employees need to make purchases, and we have a petty cash fund where it's a small amount of cash on hand to pay for small purchases. So we're going to just kind of quickly go through how to establish the fund, how to replenish the fund, record the expenses. along with debit and credit cards that the company's issued. So if a petty cash fund wants to start with $200 in cash, we'll debit our petty cash and we'll credit cash from the checking account. This establishes our petty cash fund. We've got some different items. The petty cash, use $60 for lunch and $90 for delivery. The purchasing manager has a credit card, as does the marketing manager. And they use some supply or use the credit card to purchase some items that we need to record. Here you see, we look at lunch, entertainment expense for 60, a delivery expense for 90. This is for the petty cash. So that 150 gets credited against petty cash. Then we take our $1,400 of supplies from the purchasing manager and debit advertising expense here for $1,500 and postage expense for $1,200. And these items on a credit card will credit accounts payable because they will be paid when the credit card is paid. Here you see the petty cash portion. Here you see the accounts payable portion. To replenish the petty cash, we'll debit our petty cash and we credit our cash to add more. Take money out of the checking account to increase our petty cash again. Last, we're going to look at the statement of cash flows. And we're going to understand that the statement of cash flows ties in with the balance sheet because the balance sheet shows the cash on hand at the end of the period. And the statement of cash flows reports the cash receipts and the cash payments during the period. Now there's three sections in the statement of cash flows. We have our operating activities. We have our investing activities and then our financing activities. Know that our operating activities are why we're in business, involving all revenues and all expenses. The investing activities only involve the purchase and sale of long-term assets and investment securities. That is it. So examples, purchasing or selling land or equipment or buildings that use cash. And the financing activities are only the transactions designed to finance the business through borrowing and owner's investments, such as the purchasing stock or issuing stock, selling stock, paying dividends, or borrowing money or paying back money. That is it. That's it. So we've got these various transactions and we're going to look and see, is cash involved? If cash is involved, it will go on the cash flow statement. If cash is not involved, then it won't be a part of the statement of cash flows. When we sell shares of common stock for $25,000 to obtain the funds necessary to start a business, it's a financing activity. It's issuing stock. Is cash involved? Yes, it is. It's an inflow of cash. When we borrow $10,000 from a bank and sign a note promising to repay the full amount, is cash involved? Yes. It's a financing activity. It's borrowing money from a bank and it's an inflow. The only investing activity in this whole section is purchasing equipment necessary for golf training for 24,000 cash. That is the purchase and sell of a long-term asset or sell of a long-term asset. It's purchasing equipment. It's investing. That's an outflow. We're using money. When we pay 1 year of rent in advance, that's operating. It's why we're in business. It's an outflow of money. When we purchase supplies on account, did we use cash? No. That's not even part of the statement of cash flows. We don't care about that because we did not use cash. It's not a part of our statement of cash flows. When we provide golf training to customers for cash, we are using cash. It's an inflow. It's operating, or we're receiving cash, I should say. But guys, when we provide golf training for customers on account, was cash involved? No. Therefore, it won't be part of the statement of cash flows. When we receive cash in advance for 12 golf training sessions, it's an inflow of cash. When we pay salaries to employees, it's an outflow of cash. When we pay cash dividends of $200 to shareholders, it's an outflow of cash. So, to create the statement of cash flows, we separate those activities. We start with operating activities and we start with inflows. So number 6 and number 8 were inflows from operating, 4,300 and 600, that we will show 4,900 in inflows. The outflows were for salaries and for rent. The inflows of 4,900 plus the outflows of 8,800 gives us a net minus 3,900 net cash flows from operating activities. Then from investing, purchasing equipment is an outflow of 24,000. Net cash flows from investing activities minus 24,000. From financing, we have an inflow of common stock, an inflow of borrowing from the bank, and an outflow of dividends, paying dividends. So net cash flows from financing is a plus 34,800. When we add the 3 together, we have 6,900 in cash. Cash at the end of the period is 6,900. Which of the following items would be categorized as an investing activity on a statement of cash flows? Borrowing money from a local bank by signing a note to repay the full amount 2 years later. Paid for supplies in cash. Paid for the purchase of equipment using cash, or paid salaries to employees. Which one of these guys? Awesome, guys. Exactly right. Paid for the purchase of equipment using cash. Now, comparing cash to non-cash, the ratio with Regal Entertainment versus Cinemark, the ratio of cash to non-cash from Regal 6.1%, Cinemark is 18.2%. Which of the following is true? Having too much cash can represent idle resources that are not being used to produce revenues. Yeah, that can be true. One way to assess cash holdings is to compare cash to non-cash assets. Yeah. In recent years, cash holdings have increased tremendously. Well, in this case, guys, these are all true here. So this one has us prepare a statement of cash flows for the month of August, properly classifying each of these transactions. So I want you to read through these a minute. And we're going to record these transactions. And we're going to prepare a statement of cash flows. So obtain cash from borrowing $19,000 from the bank by signing a note. Does it make sense? We're going to debit our cash and credit our notes payable. And guys, what would that be? Financing. When we pay rent for the current month, we'll debit our rent expense and we'll credit our cash, which is operating. When we provide services to customers, $5,200 for cash and $3,500 on account, we would debit $5,200 cash, debit accounts receivable $3,500, show our service revenue of $8,700. When we purchase cages and equipment necessary to maintain the animals for $8,400 cash, we debit our equipment, credit our cash. Isn't that investing? When we pay employees salaries for the first half of the month, $6,500, we debit our salaries expense, credit our cash. That would be operating. When we pay dividends to shareholders, that would be financing. When we receive cash in advance from a customer who wants to house his 2 dogs and cat while he goes on vacation, we debit cash, credit deferred revenue, but that would be operating. When we pay utilities for the month, that would be operating. When we record salaries by employees, $6,500, that would be operating. So what we do is we record the transactions involve cash, except for the salaries payable transaction on June 30th. Oh, we record salaries, but we didn't pay them on June 30th. So that one doesn't have cash involved. So we show those debits and credits that involve cash. And our statement of cash flows will only involve these items that involve cash. So we would show our inflows from customers, our outflows for operating activities, which would be rent, salaries, and utilities. Our investing is just the purchase of equipment. Our financing would be borrowing from the bank and paying dividends. Then we show the net change in cash between these minus 3,700, minus 8,400, and plus 17,450. The net increase in cash is 5350. We show the cash at the beginning of the month and then the cash at the end of the month. Okay. So our cash flows, our change in the cash balance shows how the cash flows was adjusted. Any questions before I end? Well, guys, I'm going to end this week. Have a great week, and I'll see you next week.